Welcome back, and if you are watching this for the first time, stay until the very end. Because what I am about to show you in the next 10 minutes is not a theory, it is not a projection, it is happening right now, today, as you watch this. Less than 1 hour ago, Goldman Sachs released an updated forecast raising the probability of a US recession to 30%, up from 25% just weeks ago, and up from 20% before this war began. And Goldman Sachs is not alone. Moody's Analytics has put recession odds at 48.6%. Wilmington Trust 45%, EY Parthenon 40% and rising. In normal economic conditions, the baseline recession risk in any given 12-month period is around 20%. Every single major institution on Wall Street has now doubled that number or more in 27 days. That is not a market adjustment, that is a warning. And the mainstream coverage, the oil price tickers, the interception footage, the government press conferences is not explaining to you why those numbers are moving so fast or what they actually mean for you, your family, your country's economy. So that is exactly what this video is going to do, because there is a number at the center of all of this that nobody is putting on screen. $5 trillion. That is the estimated total economic shock that this war, if it continues at its current intensity, could deliver to the global economy. Not military costs, not reconstruction costs, supply chain disruption, energy price shocks, industrial collapse, food crisis, the cascading, compounding, unstoppable economic force that begins when 20% of the world's oil supply disappears through a 24-mile stretch of water and does not come back. Once you understand how that number is built layer by layer, you will never look at this conflict the same way again. Let's start from the beginning. On February 28, 2026, the United States and Israel launched Operation Epic Fury, a coordinated military campaign targeting Iranian leadership, military infrastructure, and nuclear facilities. Within hours, Iran retaliated. Within days, the Strait of Hormuz, the 24-mile-wide waterway through which approximately 20 million barrels of oil and petroleum products move every single day, was effectively closed. The International Energy Agency did not mince words about what happened next. It called this, and I want you to hear the precise language, the largest supply disruption in the history of the global oil market. Not the largest in recent memory, not the largest since the 1970s, the largest ever in recorded history. Before the war began on February 28th, Brent crude oil was trading at approximately $67 per barrel. By the end of the first week, it had surged past $100. It peaked at $126. Goldman Sachs is now forecasting Brent crude at $110 per barrel through March and April, and warns in its most severe scenario that if Middle Eastern production remains damaged after the strait reopens, oil could still be at $110 per barrel through the end of 2027. That is not a price spike. That is a structural repricing of the global energy market. And a $10 per barrel increase in oil, sustained over time, reduces global GDP growth by approximately 0.1 percentage points, according to the Council on Foreign Relations. The $59 per barrel increase since this war began, if sustained, is consistent with a slowdown of nearly 0.6 points of global GDP. The CFR's own senior analyst believes the real number is likely closer to half a point on its own, before you account for any of the secondary effects. The secondary effects are where the real damage is being done, and the mainstream coverage is not explaining them. Most people think this is an oil crisis. Oil prices are up, gas is more expensive. That is the story. That is the surface. What is actually happening is a 4-layer economic shock, and each layer compounds the one before it. Layer 1 is energy. This one everyone understands. Oil from $67 to $126. California gasoline prices above $5 per gallon. Brent crude above $100 for the first time in 4 years. Gulf states losing approximately $1.1 billion per day in oil revenues because their oil, priced at $126, cannot leave through Hormuz to reach buyers. Iraq cut nearly 1.5 million barrels per day of output in early March because local storage was full. Kuwait curtailed production for the same reason. The economic paradox of this crisis: oil producers are generating record prices and losing record revenues simultaneously because the export route is blocked. Layer 2 is gas and the industrial chain. This is where Europe enters the crisis. Qatar, which processes approximately 20% of the world's entire LNG supply through Ras Laffan Industrial City, suspended operations after Iranian strikes hit the facility, causing 3 fires and wiping out an estimated 17% of Qatar's LNG export capacity. Qatar Energy's CEO confirmed an estimated $20 billion in lost annual revenue over the next 5 years from that damage alone. European gas storage entering this crisis was already at just 30% capacity following a harsh 2025-2026 winter. Dutch TTF gas benchmarks, the European natural gas price standard, nearly doubled to over €60 per megawatt hour by mid-March. And the consequence is not just higher heating bills. Chemical manufacturers and steel producers across the UK and the EU have imposed surcharges of up to 30% on their products to offset surging electricity and feedstock costs. The ECB warned that this trajectory, sustained through summer, risks what it calls permanent deindustrialization. In some sectors, factories that shut down because of energy costs and simply never reopen. The ECB postponed its planned interest rate reductions on March 19th, raised its 2026 inflation forecast, and cut GDP growth projections simultaneously. The EU's inflation forecast is now between 2.6 and 4.4%, depending on the duration of the conflict. UK inflation is expected to breach 5%, the highest in Europe. Oxford University's economic department modeling shows that both the UK and the Eurozone as a whole are at risk of economic contraction. GDP growth in the Eurozone is likely to slow to just 0.5% year-on-year in the second half of 2026. Economic growth in China is likely to fall below 3%. Inflation peaks above 4% in the Eurozone, above 3% in the US, and above 2.5% in Japan. And inflation combined with slowing growth has a name. It is called stagflation. The Fed's own chair, Jerome Powell, pushed back against the word in a press conference last week. He said stagflation belongs to the 1970s. But Moody's, Goldman Sachs, Wilmington Trust, and EY Parthenon are all pricing in what they are careful to call stagflation light. Not the full catastrophe of the 1970s, but a condition severe enough to trap central banks in an impossible position, raise rates to fight inflation and crush growth, or cut rates to support growth and let inflation run. There is no clean answer. Layer 3 is food. This is the layer that almost nobody is covering. 1/4 of all globally traded nitrogen fertilizer transits through the Strait of Hormuz. The Gulf region accounts for approximately 45% of global sulfur supply, a critical input for fertilizer production worldwide. The UN World Food Programme issued a formal warning this month that disruptions to fertilizer supply chains are already driving food price increases that will compound through the 2026 growing season globally. Researchers at Singapore's ICS Yusof Ishak Institute warned that an extended disruption will have a negative flow-through effect on the next season's crops. They noted that some farmers may reduce their plantings exactly as happened during the early days of the Ukraine conflict because the input costs make planting economically irrational. If farmers plant less this season because fertilizer is too expensive or unavailable, the food price consequences will not be visible in grocery stores in March 2026. They will be visible in October, in November, in December, when the harvest that was not planted simply does not arrive. And the populations that will feel that most acutely are not in Europe or North America. They are in South Asia, in sub-Saharan Africa, in the parts of the world where food price inflation is not an inconvenience, it is a survival crisis. Layer 4 is technology. This is the one that will shock you most. Qatar produces more than 1/3 of the entire world's helium supply, approximately 63 million cubic meters per year. And helium, which most people associate with party balloons, is actually one of the most critical industrial inputs in the modern economy. It cannot be synthesized. It cannot be substituted in high-precision manufacturing. And it has no viable replacement in semiconductor fabrication. Here is why that matters. Helium is used in the etching process of semiconductor manufacturing, the step where intricate circuits are carved into silicon wafers at nanometer precision. It keeps the wafer temperature stable during etching. Without that stability, the process fails. And because of its unique atomic properties, the smallest molecules of any element, it leaks through almost any container that is not specifically engineered to hold it. You cannot simply stockpile your way out of a prolonged shortage. Samsung Electronics and SK Hynix, the world's largest memory chip makers, which together supply a critical share of the DRAM and HBM chips powering global AI infrastructure, import approximately 65% of their helium from Qatar. South Korea has already moved to activate a $100 trillion market stabilization program, roughly $68 billion, in response to war-related supply chain disruption. Seoul's government has flagged 14 semiconductor supply chain materials for urgent monitoring. The Semiconductor Industry Association warned years ago that if Qatari helium supply were disrupted, there would likely be shocks to the global semiconductor manufacturing industry. That disruption is now real. It is happening. And if the conflict continues for more than a few more weeks, chip fabs will begin to face operating constraints that no amount of long-term contracts or inventory buffers can prevent. Samsung, SK Hynix, and TSMC all currently say they do not anticipate immediate disruption. Analysts note that existing inventory can last perhaps several months, but the expert consensus, Phil Kornbluth, president of Kornbluth Helium Consulting, whose entire professional expertise is this specific market, told CNBC it is getting hard to imagine that the world is not looking at a minimum 2 to 3 month shutdown of helium production and a 4 to 6 month period before the supply chain returns to normal. If he is right, and his track record on helium markets suggests he probably is the AI infrastructure build-out that is currently the single largest driver of global semiconductor demand, we'll begin to feel supply pressure sometime in May or June. And there is one more detail from this layer that is getting almost no attention. Russia is now the beneficiary. As Qatar's helium exports are blocked, China, which imported 54% of its helium from Qatar last year, is turning to Russia. Russia to China helium exports rose 60% year-on-year in 2025, and that number is accelerating. A geopolitical war in the Middle East is quietly restructuring the global semiconductor supply chain in Russia's favor, not because Russia fired a single missile, because one choke point closed and the second largest supplier happens to be a country that the West has sanctioned into partnership with China. That is what the mainstream coverage is not showing you. Let me take you through what all four of these layers combined have done to financial markets in real numbers confirmed from this week. On March 2nd, day 2 of the conflict, the Dow Jones Industrial Average fell over 400 points. The S&P 500 dropped 0.7%. The KSE 100 index in Pakistan witnessed a market halt and recorded its largest ever single-day decline, losing 16,089 points, a 9.57% crash in a single session. South Korea's Kospi index suffered its biggest crash since the 2008 financial crisis, falling up to 12% and triggering a circuit breaker. United Airlines stock dropped 6% in a single day as Gulf airspace closures and missile threats forced major rerouting of flight paths, adding hours to routes and tens of millions to operating costs. Gold, the classic safe haven asset, surged initially, then fell 6.6% as war-driven inflation expectations raised the appeal of interest-bearing assets relative to the non-yielding metal. 10-year U.S. Treasury yields have risen 31 basis points since the conflict began, a signal that bond markets are pricing in sustained inflation, not a temporary spike. The S&P 500, which Goldman Sachs and J.P. Morgan entered 2026 projecting would reach 7,600, a target that implied double-digit gains for the year, is now essentially flat year-to-date. Goldman has not formally abandoned its target, but it has stopped emphasizing it. The war reshaped the risk landscape in a way that no pre-conflict forecast accounted for. In the stock market, a flash crash hit high-valuation growth stocks on March 20th, followed by sustained capital migration out of technology and into value-oriented and defensive sectors. Energy stocks are outperforming. Defense stocks are outperforming. Everything built on the assumption of cheap energy and stable supply chains is underperforming. And the Federal Reserve, which entered 2026 already dealing with inflation above its 2% target, is now in what analysts are calling a hawkish pause. The war has added an estimated 0.9 percentage points to headline inflation in 3 weeks. The planned rate cuts that markets had been anticipating for spring 2026 have been pushed back. Goldman Sachs now projects the next rate cut will not come until September at the earliest. Higher rates, higher inflation, slower growth, disrupted supply chains, all simultaneously, that is not a market correction scenario, that is a stagflation scenario. Not every country in this crisis is suffering equally. The damage is deeply unequal, and the inequality itself is generating political consequences. Kuwait is among the hardest hit. Goldman Sachs is forecasting up to a 14% GDP contraction for Kuwait this year if the war extends into April and beyond. Iranian strikes have hit not only oil infrastructure, but desalination plants supplying nearly all of Kuwait's drinking water, creating what analysts are calling a dual energy and humanitarian crisis. Japan relies on the Middle East for approximately 90% of its crude oil imports, most of which transits Hormuz. South Korea gets roughly 70% of its crude from the Middle East, routing more than 95% through that same waterway. Both countries activated emergency response protocols within the first week. South Korea's $100 trillion One Stabilization Fund, $68 billion, was the largest single emergency economic measure any country has announced in response to this conflict. India, with thinner strategic reserves than China and heavy reliance on Middle Eastern crude, is more vulnerable to prolonged disruption than its economic size would suggest. Higher energy import costs are feeding directly into the rupee's weakness and inflationary pressures that the Reserve Bank of India has limited room to address. China, which is on Iran's permitted transit list for Hormuz, has large strategic petroleum reserves that should cushion short-term disruption. But China's 2026 growth outlook was already modest, and higher energy costs feed directly into production costs for steel, chemicals, and electronics, the export sectors that drive Chinese GDP growth, and that are already under pressure from trade friction with the US. Germany and Italy and Europe face the highest recession risk of any major economies outside the Gulf. The ECB's warning about permanent deindustrialization in some manufacturing sectors was directed most pointedly at Germany, Europe's industrial engine, where chemical and steel production is most directly exposed to gas price spikes. And in the developing world, Sri Lanka, Bangladesh, Vietnam, the Philippines, Pakistan, countries with thin foreign exchange reserves, high import dependence, and limited fiscal capacity to subsidize energy costs are quietly experiencing crises that receive essentially no international coverage because the world's attention is on the Strait. Sri Lanka raised LPG prices by 8% on March 11th, a day after raising fuel prices by a similar percentage. For a country that emerged from an IMF-managed economic crisis just 18 months ago, this is not a manageable adjustment. It is a crisis resumption. Here is the critical analysis that is absent from almost every mainstream discussion of this conflict's economic dimension. The World Economic Forum published an analysis this month that contains a sentence that deserves to be read and reread. Iran, unable to match the US and Israel militarily, is internationalizing the costs of war by targeting energy, shipping, commercial, and civilian infrastructure across the Gulf. The logic is simple: raise the price of escalation until pressure for de-escalation builds. That sentence is the entire strategic architecture of what Iran is doing. Iran cannot win a conventional military engagement against the United States. It knows this. Its military planners have known this for decades. So Iran is not trying to win a conventional military engagement. Iran is trying to make the war so economically painful for so many countries, across so many supply chains, touching so many financial markets, that the political pressure for de-escalation becomes stronger than the political will to continue. Every refinery strike in Kuwait is not primarily a military operation. It is a message to Kuwait's trading partners, to Kuwait's bond markets, to Kuwait's government. This continues until the calculus changes. Every drone attack on Qatar's Ras Laffan is not primarily about destroying LNG infrastructure. It is about making European governments call Washington and ask how long this is going to go on, because their gas storage is at 30% and winter refill season is approaching. Every disruption to helium supply from Qatar is not primarily about damaging Qatar's economy. It is about making South Korean and Taiwanese and Dutch semiconductor executives quietly begin calculating what a 4 to 6 month helium shortage does to their production schedules, and then making those calculations visible to their governments. Iran is using economic pain as a military weapon, and it is working not because Iran is winning on the battlefield, but because the economic consequences of this conflict are not contained within the battlefield. They are spreading through every supply chain, every energy market, every financial market, every food system that connects the Gulf to the rest of the world. The World Economic Forum's analysis captures this precisely. What begins as a battlefield shock hardens into a geoeconomic one, and there is a contradiction embedded in the U.S. strategic position that the WEF analysis names explicitly. The U.S. has imposed enormous costs on many of the same economies it relies on as trading and strategic partners. South Korea, Japan, Germany, India, the UK, these are not adversaries, these are allies, and they are absorbing economic damage from a war they did not start and were not consulted on, at a scale that is testing the political sustainability of the coalition the U.S. needs to maintain pressure on Iran. Goldman Sachs published 3 scenarios for how this plays out economically, and understanding them is the clearest way to understand what is actually at stake. Scenario 1, the most optimistic. Pre-war oil flows through Hormuz are restored within 1 month. Brent crude averages $71 per barrel in the fourth quarter of 2026. Global inventories drop by 6% but are manageable. Strategic petroleum reserves from IEA member countries absorb approximately half of the shortfall. Global economic damage is real but limited. Scenario 2, a 60-day disruption. The closure extends through April 28th before gradual recovery. Brent crude surges to an average of $93 per barrel in the fourth quarter. Inventory impact expands to nearly 20%, 1.8 billion barrels. Policy responses can only offset about 30% of the shortfall. Stagflation becomes the dominant economic reality across Europe and parts of Asia. Scenario 3 extreme, a 60-day disruption coupled with long-term damage to Middle Eastern production capacity. If production in the region remains 2 million barrels per day below normal even after the Strait reopens, Brent crude stays at $110 per barrel through the end of 2027, not 2026. 2027, the economic damage compounds year over year and becomes structural, not a shock that recovers, but a new normal that reshapes industrial location decisions, energy investment patterns, and geopolitical alignments for years. Today is day 27. Goldman Sachs currently assumes Hormuz flows remain at approximately 5% of normal levels for a 6-week period before gradual recovery, which puts us somewhere between Scenario 1 and Scenario 2, and moving towards Scenario 2 with each day, the conflict continues without resolution. The $5 trillion headline figure in this video comes from the aggregation of all 3 scenarios across all 4 damage layers: energy, gas, and industry, food, and technology, modeled across the full spectrum of affected economies. It is not a single institution's projection. It is the upper bound of what a prolonged scenario produces when all the compounding effects are added together. Analysts at Solability have estimated up to $3.5 trillion in global GDP at risk. The WTO projects 0.3% or more off global GDP growth in 2026 if oil prices remain elevated. The IMF has not yet published a formal revision, but its April World Economic Outlook, due in 3 weeks, will. Less than 1 hour ago, Goldman Sachs confirmed its recession probability at 30%. Moody's is at 48.6%. The ECB has paused rate cuts. South Korea has activated a $68 billion emergency fund. The KSE 100 in Pakistan recorded its largest single-day crash in history. California gasoline is above $5 per gallon. Qatar's helium is offline. 1/3 of the world's semiconductor-grade helium has left the market. Oil is above $110, and Goldman Sachs is forecasting it stays there. And the conflict is on day 27 with no ceasefire in sight. Iran has rejected talks. Trump has threatened to obliterate Iran's power plants if Hormuz is not fully reopened. Iran responded by threatening energy and desalination infrastructure across the entire Gulf if those strikes happen. The escalation ladder is not descending, it is climbing. The IEA called this the greatest global energy and food security challenge in history. The WEF said it is a structural shock to the world economy, delivered at a moment of geoeconomic fragility. And Iran's strategic logic raised the economic price of this war until the pressure for de-escalation exceeds the political will to continue, is running on a clock that ticks with every day that oil stays above $100, every day that Qatar's LNG stays offline, every day that helium containers run down toward the 35 to 48-day storage limit that marks the point of no return for semiconductor supply chains. The $5 trillion shock is not inevitable. Scenario 1 exists. A swift resolution would limit the damage. But Scenario 1 requires a decision, a diplomatic off-ramp, a negotiated halt, a framework that allows both sides to step back without claiming defeat that, as of today, neither side has been willing to take. Every day that decision is delayed, the economic clock advances, and at some point, the bill becomes impossible to hide from the people being asked to pay it. That moment when the economic reality of this conflict becomes impossible for governments to paper over with press conferences and interception footage is the moment that changes everything. We are not there yet, but we are closer today than we were yesterday.